Good morning. Is everybody there? Can you hear me? Can somebody, I guess somebody can type a message just to verify that you can hear us, that we're working right here. Any message there, Louis? No? Can you send a message there, Lydia? Maybe get a verification that they can hear us, at least one large group that's standing by.
Yes, they can hear. I just got a text.
Okay. All right. Well, good morning to all you fine realtors. We're here today for a short sale seminar. This seminar is geared towards realtors, and we're going to help you basically analyze and list short sales and also close short sales. My name is Richard Adams, and I'm an attorney. I'm a real estate and bankruptcy attorney. I've been practicing since 1988. During that time, I've always practiced real estate and bankruptcy law. If you don't mind, I'm going to give you a little bit of background on the firm, and then I'm going to cover a couple of key points that always inevitably come up as questions. And then I'll be turning most of it over to Lydia Quesada. She is also an attorney with our firm, and she is the attorney at our firm that actually heads up the short sale team, the short sale department. On the bankruptcy side, we practice consumer bankruptcy for the most part. We also practice a little bit of corporate or business bankruptcy. We practice Chapters 7, Chapter 13, and Chapter 11. On the real estate side, we practice, well, I should say we have a title company where we close title. It's an independently owned entity by the name of Title Partners of Florida, Inc. And on the real estate side of the firm, most important here today, most relevant here today, we have a short sale, an extensive short sale mitigation department. Again, Lydia Quesada is the attorney heading up the short sale department, and she's followed by 9 processors, of which Darlene Gonzalez is the lead processor. And the way we work the short sales is we usually assign a processor to the particular real estate agent, and hopefully they're able to develop a good and lasting working relationship. Our offices are located throughout South Florida. We have offices in Miami, Kendall, in Broward County, Davie, that is the city of Davie in Broward County, and then also in the city of Hialeah. But for the most part, short sale processing nowadays is completely electronic, so the location of the office is pretty much irrelevant these days. We've devised let me back up. We've devised a system for short sales that we feel is very convenient and easy for the real estate agent to use. What I mean by that is, first of all, everything that you need for your short sale is available on our website. Your entire short sale package can be accessed on our website by simply clicking on the short sale tab at the home page of the website. And the website, I should give you the address, I guess, is www.richardadamslaw.com. That's richardadamslaw altogether.com. At the home page of the website, you click on the short sale section and scroll to the bottom of the first page of the short sale section, and you will see a tab that reads Short Sale Package Non-Prudential Realtors. That would be your short sale package, unless you're a Prudential agent, in which case there's a separate tab, Prudential Realtors Only. The reason for that is that we do a lot of the short sale mitigation for Prudential Florida Realty throughout the state of Florida, and they took our package and made a couple of modifications to it. So assuming you're not a Prudential agent, you would click on the top tab that says Short Sale Package, Non-Prudential, and basically everything you need is there. I can run through it quickly now, or I guess I can just go ahead and go through it in detail now. The first document there is the checklist. That'll give you tell you what you need for your short sale. Example: 2 months of bank statements, 2 paycheck stubs, 2 years of tax returns, the hardship letter, etc. The next document is simply a directory of our firm, and those that work in the short sale department are identified as such, short sale department. And I should also point out that our respective cell phones are there. Lydia's cell phone as well as mine, and I should point out that when I say that we've come up with a system for short sales that's convenient and easy for the realtors to use, well, one aspect of it is everything's on the website. And by the way, these forms, we're going to be going through them now. These forms are in PDF format so that you can go in there and populate them. But I should point out, or I don't want to jump to that yet, Louis. Let me just get through the package first. The next document in the package is contact information for the seller's lender or lenders, seller's mortgages, as well as the homeowners or condominium association. The next form is the authorization to speak to the lender and or the association, obviously to be signed by your seller. The next document is the financial worksheet that the seller's bank requires. And here I should point out that this is a generic financial worksheet. A lot of the banks nowadays are requiring their own particular worksheet, their own particular form. And so what you would do is you would click out of the package and go back to the short sale section where the short sale tab was. Down at the bottom you'll find another tab, or you'll see another tab that reads Lender's Short Sale Package. Click on that and check to see if your seller has one of these banks. If they do, your seller has a bank that requires their particular affidavit form. So you would use, for example, if you had Chase, which is listed on there, you would use the form for Chase along with the rest of our short sale package. So instead of using the generic financial application in our package, you would use the Chase application and then combine that Chase application with the rest of our package. Moving on, the next document is what's titled Engagement Letter, and what that is that's the contract, I should say, between us, the law firm, and the seller for the short sale mitigation services. We include this in the package because we like for you to try to get it signed up front when you're going to take the listing. It's important for a number of reasons. First of all, it locks in our fee, and it clarifies, and I'm going to talk to you about the fees in a second, and it clarifies that we're not going to charge your seller a fee, that we're not going to charge the seller's agent a fee. And I'll go into our fees in a few minutes, but that's one important aspect of getting it signed. Another important aspect or reason for getting the engagement letter signed, and the reason for which we include it in our short sale package, is that the engagement letter defines our respective roles in the short sale transaction, and it limits our roles in a way that protects us. What do I mean by that? For example, it explains that we are not going to represent this seller in the foreclosure action, in the foreclosure proceeding itself, that our representation is limited to the short sale mitigation aspect of it, the short sale process. It also clarifies that we're not representing the seller, for example, in a loan modification. Now, in particular, when you're dealing with HAFA, they're required to first apply for a modification under HAMP. So a lot of these sellers sometimes think that we're representing them in the modification. The engagement letter clearly excludes that modification representation. So it defines our respective roles, and it protects not only us, the lawyers, but it protects you, the real estate agents. It also finally gives, the other reason for getting it signed up front is it gives us an idea of whether this seller is going to be cooperative. And we'll go into some detail on that later on, but you want to know if you have a cooperative seller right from the beginning, from the get-go. You don't want to learn later on that your seller is not cooperative after you've worked the entire transaction and now you're coming up on the closing date and they don't want to cooperate or what have you. So it just kind of gives you an indicator as to whether you have a cooperative seller. The last document is in the package, in the short sale package, is the short sale rider. This is the FUR bar, the new as-is contract, the FUR bar. This is the rider for the short sale. It's called comprehensive rider, but in reality it's a short sale rider. And we went ahead and we populated it with deadlines that we felt were appropriate, but of course you can modify that. You can use this if you want to, along with your contract, or you can just choose to use your own addendum or different contract. We like for you to use this addendum because we feel it balances the interests of the buyer and the seller very adequately, very well. And at the end, at paragraph 11, at the end of the rider, we've added a clause selecting us as the title agent and also clarifying that we will be handling the short sale mitigation. So kind of locks that in there so you don't have to even worry about marking the contract or worrying about whether the buyer might try to impose their title company or impose their, I guess their title company, or if the seller might try to go with a different short sale mitigator. So anyways, that's the short sale package. I'm going to turn it over pretty soon here to Lydia, and she's going to get into the substance on short sales. I would like to mention one more point. As far as our fees are concerned, or I should say, to be abundantly clear, we do not charge a fee to the seller. We do not charge a fee to the seller's agent, whether or not the transaction closes, whether or not the short sale is successful. When and if the transaction closes, short sale closes, we get paid by the seller's lender via the HUD, and we limit our fees to whatever the seller's lender approves. We don't charge the seller, we don't charge the seller's agent, and we try not to shift any fees over to the buyer's side of the HUD, because that tends to create a lot of friction and problems with the buyer as well as the buyer's agent. In the engagement agreement, at the first paragraph, I should say, of the engagement agreement treats the issue of our fees, and it says what our fee is and how we're going to get paid at closing, if and when the transaction closes, et cetera, et cetera. But there is one sentence in particular that very clearly clarifies that there is no charge to your seller. And I mention this in case your seller, as they often do, they give you a hard time about being charged anything. Just read them this sentence. It reads, quote, "Neither seller nor seller's real estate agent will ever be responsible for the fee or any portion thereof." So that puts that to rest, and you can move beyond that. And that's in the instance that your seller is concerned that he or she is going to be charged a fee somewhere along the line. That's about it. I'm going to turn it over to Lydia now. She's going to get into the substance on short sales, and I'm going to be helping her throughout. So here we go.
Good afternoon to all of you. It's a pleasure, and thank you so much for giving us your valuable time. And hopefully you'll learn a lot from this webinar. And if you have any questions, as Richard said, you can feel free to call me. My cell number is 786-975-9889. I'm always here to help you evaluate your short sales and answer any questions that your sellers may have, and answer basically just to help you out there, because I know you're doing a very difficult job, and these days you're expected to not only be realtors and have knowledge about real estate in the market area, but you're expected to be tax lawyers, accountants, attorneys. I mean, these days the real estate market has really changed, and I'm very sensitive to that, so I'm here to help you. That being said, I'll start the presentation by basically a definition of what a short sale is. I understand that perhaps some of you out there have a lot of short sale experience and know exactly what it entails, and some of you perhaps have been wary of jumping into the water because of all the tricks and traps and all the nightmares that you've heard about short sales. So many realtors stay away from them, and so I'll just start with a basic understanding of what a short sale is. Short sale basically is when all the outstanding loans on the property are greater than the proceeds from the sale, meaning if a person owes $200,000 on their mortgage, yet the value of the property is $100,000, and that's all they hope to, all they can hope to get in an offer. Obviously, there's not enough money there to pay off the lender in full. And these individuals that are experiencing a hardship, most of them do not have the money to come to the table to make up the shortfall. So in this case, the homeowner would enter what's called debt settlement, and submit a short sale package to the lender showing their finances and their inability to pay, and then the lender would agree to accept a lower payoff amount, accepting an amount that is fair market value for the property. The benchmark of a short sale remains hardship. That is the #1 factor. It's not to say that we haven't successfully negotiated short sales where, in fact, somebody has not had a hardship. That happens as well. But in those situations, it's a little bit different because I very strongly and carefully advise the seller that the chances of them walking away with no deficiency and no promissory note are very slim. And people who do have assets and just want to get out from under a bad mortgage and that have assets understand that, and many of them are willing to make that business decision. So, for example, they owe the shortfall to the lender is $100,000. The lenders, we could negotiate back and forth with the lender in order to get a release based on a negotiated payout amount. And many times we end up with a great result. But those individuals are told ahead of time, look, you don't have a hardship, this is what you can expect, A, B, and C. So the #1 benchmark for those individuals, most of them who, of course, want to walk away with zero deficiency, is, do you have a hardship? The lenders are not in the business of bailing anybody out. Instead, they're in the business of being bailed out. But that's for another seminar altogether. Lenders, of course, want to know, if I'm going to forgive this individual for the remaining debt, I want to know that they don't have the ability to pay. So the lenders, of course, look very carefully at tax returns, bank statements, pay stubs, and they are doing now what they should have done back then when the loans were given. They're actually underwriting the situation and making sure that if they forgive somebody for the deficiency, it's because that person has a true hardship. The lender's not doing them a favor. In fact, going through the foreclosure process is a very lengthy process. In the state of Florida, it takes 2 years or more because it's still a judicial process, and it costs a lot of money. We have one of the highest filing fees in the country for foreclosure cases. So, the lenders are making a business decision and saying, if this individual doesn't have enough money to pay me, and then I have to go through 2 years of foreclosure and then recover nothing in the end, this doesn't make any economic sense. Let me look at the offer on the table now, time value of money-wise, let's make a deal. There's actually a statistic out there which is very true, and this is something that the lenders, it's actually a statistic that's been out there for a few years, and lenders now are realizing and understanding what we've been telling them all along. On a subprime loan, the loss to the bank is about 85%, whereas the average loss to the bank when they accept a short sale is only 15%. So that's really important to consider. this next one is basically what's going on in the lender's mind. They want to know, bottom line, that they're receiving fair market value for the property. Banks don't want to be lowballed. So when we submit an offer to the lender, the first thing that they will do is they will order a BPO, which is a broker's price opinion. They will order it themselves. And what I've seen lately is that banks, obviously they cut a lot of corners, and a lot of times that they're sending BPO agents out to the property that have no familiarity with the area whatsoever. So, for example, if you're over in Coral Gables, they may send somebody over from Boca Raton that really doesn't have any idea what's going on, and there's some pockets of the county where just one street over can make a huge difference in prices. So I always encourage the agents to please, if they, best case scenario, if they can be present when the BPO is being conducted, that would be great, because that way both agents are exchanging information, they're talking, and rarely, if ever, do we end up with a BPO that's unrealistic. If obviously, considering your schedules, if you cannot be present at the BPO, at least making contact with the BPO agent and perhaps emailing them some comps, your market analysis, your reason for why you priced the property where it's at would be of tremendous help. Because once the lenders get back the BPO from their agent, and it's much, much higher than what we've listed the property at, it is quite a challenge to get them to, basically to bring them back to reality. When you're dealing with an FHA loan, we can order a second BPO. But if it's not an FHA loan, then there are certain parameters and things we have to then do. We have to challenge valuation. And challenging valuation is time-consuming because there are many, many factors involved. The loan would have to go back into underwriting and back for investor review and approval again. So at all costs, if we could at least have some contact with a BPO agent, that's wonderful. I mean, unfortunately, in the minority of circumstances, you have BPO agents that don't even ever come out to the property. They just have somebody come and photograph it, and they, sit behind their desk somewhere in another county and assess the value. In those situations, it is what it is. But most of the time, you get agents that are actually going out there and doing the BPOs. In stating, of course, that the banks want fair market value, there are instances when the bank will take less than its fair market value, and that's where there are problems with the property. The last thing the bank wants is a problem with marketability as an REO. So if the roof was done without permits, guess what? When the bank takes that property back in foreclosure, they're going to have to put that property to code. It's going to cost them a lot of money. We've actually closed transactions where the bank has taken far less than fair market value, where it's been disclosed that the roof, for example, was done without permits. So if you know that something was done without permits, please put it in the listing, because when we submit a short sale package, we also submit the listing to the negotiator, and they already know. It's already a red flag for them that they are not going to receive fair market value because there are X, Y, and Z problems with the property. Okay. When we submit, of course, an offer to the lender, the most important document to them is the closing statement. When we submit an offer to them, we have to just submit a draft HUD. And when the bank looks at that HUD, they look at their net. Many lenders have what's called a minimum net requirement that, of course, they don't share with us. But since in a short sale transaction, the short sale lender is paying all the closing costs, our fee, realtors' commissions, everything. They're paying it all. So they, for them, it's very, very important to see what that minimum net is. For example, the lender usually will not pay more than $6,000 to a junior lien holder. When we submit a HUD, obviously we have to put in the HUD if there are junior liens, if there are tax liens, if there are judgment liens, if there's, HOA is past due. All of that has to be in the HUD. It's very important when we submit a HUD that it be as accurate as possible, because the lender is going to analyze the short sale and analyze the approval based on what they're going to net in the transaction. So they want to see what all of their closing costs are going to be. And generally, they don't pay more than 6 months of delinquent HOA dues. Where I have seen that they've paid more, and sometimes even all, is where the HOA has actually put a lien against the property. So if there's no lien against the property, no HOA lien, I see usually about 6 months up to 12, generally 6 months up to 12. And where there is, in fact, a lien, I've seen a lot more. I've even seen payouts for special assessments. What all lenders, though, what they always tell me is that they will not pay attorney's fees for an attorney collecting for an HOA or suing on behalf of an HOA. They don't pay attorney's fees, and they don't pay like any late fees. They call them junk fees. They don't pay that. And also, they generally will not pay any tax liens or judgment liens. So this becomes very, very important, and I'll discuss this a little bit more as we go along. If there are federal income tax liens on the property, we want to know that from the very, very beginning, because the IRS will eliminate its lien. They do it, but it requires time. Our country is very, very big, but in fact there's only one office in the whole country for the IRS that deals with tax lien eliminations. And so, with more and more short sales across the country, they're becoming more and more burdened with requests to eliminate or subordinate tax liens. So if we do have a tax lien issue, I need to know right away. Also with judgment liens, I need to see if what those judgment liens are, and start to get a feel for whether those can be negotiated up front. And of course I'll go into a little bit more in the presentation about how I in fact find these liens and judgment liens. But don't be scared. If you use my if you choose to engage our services, I will help you with that. I'll help. Part of helping you qualify your short sales is doing the research for you, finding out if there are tax liens and judgment liens, because I can easily find them in the county records. So I would be able to help you with that. I mean, the worst case horrible scenario is that we get an approval letter, run title, and then we find all these things that we never dealt with. So those are the things we try to avoid at all costs. Also, mortgage insurance. Mortgage insurance companies are a real pain in the neck to deal with. They, most of the time, require a promissory note or cash in order to approve a short sale. And, many sellers get frustrated and they say, well, tell them that if this goes to foreclosure, they're not going to receive anything. And, well, I mean, the thing is that the mortgage insurance carrier has already suffered its loss. They frankly don't care if the property goes to foreclosure or not, because once the loan goes into default, the lender makes a claim against the mortgage insurance policy. The mortgage insurance policy is what it pays out whatever the contract rate is, and then they retain a subrogation right, or a right also to approve any mitigation. That's just one of the things they retain as a result of the payout on a claim. So when they make their demands, they don't care if there's a hardship or not. They push and shove. And we are successful at negotiating down some of the ridiculous mortgage insurance demands, but rarely do they just agree to take nothing. So that's one thing to really keep in mind, and I always ask sellers whether they have mortgage insurance. Many of them don't know. I ask them the follow-up questions to find out. If they do, I ask them, did you put down at least 20% when you bought the property? No. A lot of times I have them pull out their closing statement to see if there's a holdback at all for mortgage insurance, or I have them call the bank and find out if there's mortgage insurance, because if there is, I like to manage their expectations and have them understand of what the possible result is. And many times people tell me, if I have to sign an interest-free promissory note, for X amount of years, I'm fine with that as long as I get out from under this bad mortgage. What people hate are surprises. Okay. Now going into the laws that govern short sales. It's HOFA, which is the Home Affordable Foreclosure Alternative Act, and the MDRA, which is the Mortgage Debt Relief Act. HOFA was introduced in 2010, and that law will be around until December 31st of 2012. I don't know whether it's going to be extended or not. I'm kind of mixed feelings. I guess it just depends on what happens with our next presidential election, but that's for another day. That law basically does give quite a bit of incentives to borrowers who participate in the program. The most important being that it waives the deficiency and it gives them up to a $3,000 relocation fee, which for many of them is very, very important. But what I see really motivates a lot of these borrowers to go through HOFA is the guaranteed waiver of deficiency. Now, it is a government-backed program, so it does have its red tape. The borrower must go through a pre-approval process, and one of the things that involves is that they have to go through a mortgage modification counseling. They don't have to accept it. I just tell the sellers to grin and bear it, listen to what they have to say, and just tell them thanks but no thanks. But that's the only way to move the loan through to continue with the HOFA. And HOFA, I must say, very, very importantly, is only for primary residences. It's definitely not for any type of investment property. It's only for primary residence. And one good thing about HOFA is that, if it's a primary residence, we can submit the short sale package, the one that Richard was talking to you about earlier with the financials. We can submit it even before the property gets listed or even before there's an offer. Preferably the property will already be listed, but we can submit before there's an offer. And we get the wheels churning with HOFA because it's a government program. It's going to tack on about 60 to 90 days onto the processing time. It has to go through the FDIC. The good thing is that if the loan does become HOFA certifiable, means that we will get a price that the lender wants for the property. And that's probably why a lot of you out there on MLS will see pre-approved short sale. That's because the loan has been qualified under HOFA, and the lender has given a number that they want for it. The good thing with getting the letter that the pre-approval letter is that the bank will give us 120 days to get a contract. So it's not like we get the HOFA certification letter and then we have to immediately sell. No, we have 120 days to get a contract, but at least at that point what the lender is looking at. There have been significant policy changes to the HOFA program. They've been amended even after February 1st of 2011, but what I see is a lot of lenders do not even use it properly. And what I mean by that is that one of the things that changed about HOFA was that before the loan would not qualify for HOFA review if the mortgage payment was less than 31% of the income. That requirement has been done away with officially, but I still see a lot of lenders using the 31% benchmark, and I tell them all the time that they're wrong, but they just shrug it off and they continue to use, the incorrect guidelines. So when I look at a short sale package and I look at the financials, and income and expenses and mortgage payment, I do kind of do the math and see if whether I think based on the numbers that the person would qualify under HOFA. Even if I don't think that they will and we don't have an offer, I'll still go ahead and try to get it qualified because some lenders actually do know how to use it and use it properly. If the loan for whatever reason does not become HOFA certifiable, because some lenders do not participate in HOFA, and also, even though sometimes a lender does participate in HOFA, maybe perhaps the investor that owns it does not, so then they can't offer it. That's not the end of the world. If we don't have an offer at that point, we just wait until there's an offer and then submit the package. And if there is a hardship, the lenders end up under their own programs forgiving the deficiency anyway. Okay. One other good thing, I guess, that has happened with HOFA is that with the policy changes is that before, for example, if I had a borrower who had a large second mortgage, I used to be capped at the 6% payout to junior lien holders. That has been eliminated, so I have seen times when even though a loan has become HOFA eligible and I've gotten more than a 6% payout to a junior lien holder, which has been great. When we submit a loan under the HOFA program, lenders stick to the requirements. They do issue us a response within 30 days, and what I mean by a response is not an approval, but at least they issue us an acknowledgement, and that's in the acknowledgement where they have us call, direct the seller to call in to a certain 800 number to qualify for the mortgage modification counseling. So I do see that the response times are getting better, and one good thing about the policy changes as well to the HOFA program is that some people are interested in keeping their home through modification, and maybe they have a modification request pending, and and they wanted to perhaps try to see if their loan qualifies for short sale as well. Just kind of think having two things going along at the same time. It is possible now. I mean, I have people who are being considered for HAMP and HAFA simultaneously. More often than not, they end up going for the short sale because, as we all know, modifications really don't work. They're just a Band-Aid. Banks are not writing down principal balance or doing modifications in a way that really make these homes affordable. Many people complain that after the modification, the mortgage payment's actually higher than it was before. And that's because when somebody does a loan mod, they're then required to have escrows put into the loan, which many times results in a mortgage payment that is too high for them to afford. In the HAFA program, we no longer are limited to a 3-month residency period. The person could have moved from the property at some point within the past year, the past 12 months, and still qualify under HAFA. The only thing is that we have to provide third-party verification. I have to provide a utility bill or something like that to show that the person has in fact lived on the property within the past year. Okay. Next, we go to the Mortgage Debt Relief Act. That is the act of Congress that says that there is no capital gains tax on the debt forgiveness of the sale of a homestead property. And that's important because many people out there think that they're going to be taxed if they sell their property in a short sale. Well, under the MDRA, the Mortgage Debt Relief Act, if they sell their property in a short sale and the bank forgives the deficiency, they're not taxed on it. The only thing is that the debt cannot be as a result of a refinance or something. If the person did like a cash out refinance and then took trips around the world and bought luxury cars, that doesn't work. It has to have been a loan to purchase the property. And if it is a loan to purchase the property, then yes, we can get the tax liability completely forgiven. And but the loan must close on or before December 31st of 2012. Just because the person, for example, doesn't qualify under the Mortgage Debt Relief Act, maybe because they did do a cash-out refinance, or if the property was an investment property. I mean, it still doesn't mean that there's going to be a tax liability. And I've had like numerous conversations with CPAs about this, and they tell me there's just because of the way that the CPAs can work the numbers and rarely if ever. I had one CPA tell me, it's impossible to have a tax liability. But I always have my individuals that are short selling with assets and they're short selling investment properties always check with the CPA. But obviously some people after a short sale will file bankruptcy for any other, perhaps other debt problems. Bankruptcy is an automatically waives any type of tax liability. No debts that are discharged in bankruptcy are ever considered taxable income. Also, insolvency. Let's just say, for example, that we have an individual who is selling an investment property and the bank is forgiving $150,000 of debt because of a hardship. So they issue the 1099 that says, I hereby have forgiven, Joe Smith of $150,000 of, mortgage debt. In order for that person to be taxed, they'd have to have on a balance sheet assets worth more than $150,000, and rarely, if ever, do you see anybody who on a balance sheet has more assets than liabilities. So it's just very, very rare for there to be a tax liability. So that's something that's a big misconception out there, that they're going to be taxed. Just keep in mind that if it's a homestead property, they don't have to worry about, and they qualify under HAFA, they don't have to worry about the deficiency, and they don't have to worry about the tax liability under the MDRA, as long as the loan closes on or before December 31st of 2012. If it's non-homestead and the person is filing for bankruptcy or has filed for bankruptcy, there is no tax liability. Probably wouldn't be anyway because of the way the IRS code is written. And the accountants would attach a Form 982 to the tax return showing that there would be no tax liability. And moving on to like the short sale process itself, and where we really jump in, I think our services are pretty unique, is that I help you in qualifying the short sales. I help you in dealing with a lot of these questions that the sellers may have. Many sellers want to know, why don't I just do bankruptcy? Why don't I just, let the property go in foreclosure? They have a lot of, a lot of neighbors and friends have told them things, and they're confused. And there's a lot of bad advice out there. And many people think that just because their friend or neighbor ended up with one result, that they should end up with the same result. And every situation turns on its own set of facts. But our firm processes and negotiates the short sales. We deal with all that, all the headache, basically, dealing with the lenders, negotiating with the lenders, providing the lenders with information, updated financials. One thing I do tell the sellers up front is I tell them, I said, look, this is a debt settlement is what this really boils down to. And there are various levels of this short sale process, and this loan will go from the negotiator to recommending into underwriting that the loan be approved. It will go into underwriting, and then it will go to an investor. And that takes some time. And during the process, you're going to have to give me updated financials. You're going to want updated bank statements, updated pay stubs. For example, loans that I have in process now, negotiators shortly are going to start asking me for 2011 tax returns. And that's because once an investor looks at and gives the final okay on the loan, he or she must have everything at hand. They don't know if last month the person received a huge bonus, won the lottery. Those are exaggerations, but you can see where I'm going. They want to know if they are properly approving a short sale, because many of these loans are owned by 401ks, are owned in a fiduciary capacity. So whoever is managing that 401k or money market or pension has to be sure that they're doing it correctly, and they're not going to be sued then by investors for violating their fiduciary rights. So it is a process, and I tell them, the sellers, to please be patient and understand that they're going to have to give us updated financials through the process. And as Richard said, our package is available directly on our website at www.richardadamslaw.com. And we also have there our lender-specific packages. Once we receive a package, we underwrite it basically within 48 hours. We review everything. We review the hardship letter. We review it against the financials. I look at income. I look at expenses. And I see whether this is going to make good sense to an internal processor. I also look at it, and based on what I see, I maybe may call the seller and make some suggestions or give them my take on where I think we're going to be. If you use our service, we'll give you weekly email updates about what's going on your file. And again, you always have access to me, whether by email or by cell phone, so you can always call me and ask me. Like Richard said, our fee is paid directly by the lender as a closing cost on the HUD. It's fully disclosed and negotiated. We charge the lender $3,500 for the short sale mitigation. Rarely do we ever get that amount, but we get whatever fee the lender gives us on the HUD, fully disclosed. This is knowing the sellers is this next part of the short sale process. I think this is probably the most challenging part. And this is the part where, the realtors really rely on me, because it's, I think, the most difficult aspect of a short sale is knowing the seller and managing their expectations. It's a critical that the seller receives the right advice, that they receive the right type of know-how, and that their case is analyzed just based on their specific facts, because there's so much bad advice and misconception out there. So many people think that they can just, oh, I'm not going to negotiate with the bank. I'll just file bankruptcy. And we're a bankruptcy firm as well. And a lot of times I'm bringing these people down to reality and tell them you don't even qualify for bankruptcy. Or if you did bankruptcy, you would end up paying more in your plan to these creditors than you would be probably in a short sale. So many people throw around these big words, and they don't understand what it really fully means in the bottom. And knowing the seller, I think the number one thing is, does that person have a hardship? I help with those questions. There are some people, for example, that they may hand you over their tax return, and you may think these people are never going to qualify because you see like a big gross income number. Well, back in the heyday when the banks were giving loans, maybe the wife was the only one that signed on the promissory note. and now, she's a stay-at-home mom, or now she's unemployed and only the husband is working, and maybe he has a very, very large salary. Well, from the lender's perspective, the only person they can look to in order to collect their debt is the wife. So while the household income may be very, very high, her income is low, so it qualifies as a hardship. But those are things that I can help you with. Also, I look at what kind of assets they have. Some people have multiple properties. Some of those multiple properties are even paid off. So I help them and I analyze their situation and I tell them what they can expect out of the short sale if they do have other properties and other assets that are fully paid off. I tell them that they could probably expect a counteroffer from the bank in order to accept the short sale. And many people are more than willing to enter into negotiations with the bank and get out from under a bad loan, and just making sure that they keep their other investment properties safe. Because if the lender does take them to foreclosure, the lender can get a deficiency judgment against them and then foreclose on their other properties in order to satisfy those judgments. Another thing, one important aspect as well is, and when you're looking at the seller, of course, we're looking at, since your commission hangs on a closing and our payment as well hangs on the closing, we're all working together and we're all working for a contingency. I like to analyze, the short sale in terms of what chances do we have to really be able to close on this. And one of those questions, one of those things on my mind when I'm asking the question about whether this is a loan that I'm going to be able to successfully bring to closing is how many mortgage liens are on the property. I mean, I've seen people with as many as 3 and 4 mortgages. Obviously, the more mortgages a person has, the longer it's going to take to get a short sale approval, and the likelier the chance is that you may not have a buyer that will be willing to wait that long, or perhaps the second and third mortgage lien holders won't be happy with what the first lien is offering, and they may, not approve the short sale or put in some, some terms that may make the seller not want to go through. So I ask about mortgage liens. We have hundreds of transactions where there are second mortgages, but, that's fine. I just like to know ahead of time what I'm dealing with, and also whether the second mortgage lien balance is very, very high. Like, for example, Wells Fargo is not releasing any liens, any mortgage liens, unless they're paid 10% of their mortgage balance. And where the mortgage balance is very, very high, I like to know that ahead of time, because I can pretty much gauge what the first will pay. And if there's a difference, then I have to have a sit down with the seller. Or through you, we need to, communicate that to the buyer that they may need to come up a little bit. So I look very carefully at second mortgage balances. Another is judgment liens. It's very, very important to know whether there are any judgment liens against the property. And a little bit later in the webinar, I'll show you, like, for example, in the Dade County Public Records, where I would go to find that. But it is, you actually do a name search and find out if there are any liens against a property. Very important, because if there is a judgment lien against the property, once we pull title, it's going to come out. And at that point, I wouldn't want to have already an approval letter and then have to go back to the bank and say, oh, bank, well, guess what? You have to pay this as well. So if there's a judgment lien against the property, I want that in the HUD from day one. And sometimes people don't even know that they have a judgment entered against them. So I ask them, have you ever been sued? Has anybody ever knocked on your door and turned in some papers that said respond in 20 days? I ask them questions geared toward, what's their credit history? Have they been sued by their credit card companies? Just to get an idea of what could be back there. Another one is, have they done any repairs or improvements without permits? And this goes back to the other issue about the property. If there's an issue with the property, we want it in the listing, because I want to be able to communicate to the lender that they're receiving less than fair market value, and why. A big one is, are they in foreclosure? Just because they're in foreclosure doesn't mean that we can't process the short sale. We absolutely can. We just have to be very, very careful with where in the foreclosure process we are. If there's already a sale date set and you're considering taking a listing, it's not going to be a good investment of your time, because unless that sale date is moved, a lot of these lenders won't even assign a negotiator. They'll say, get the sale date moved, and then we'll assign a negotiator. So it becomes very, very difficult once there's already a sale date. And many people, they got served with foreclosure papers, and then many of them never did anything about it. So we have to then go in and research and look at the foreclosure case docket and find out where we are and making sure we have enough time. Another thing is during the short sale process itself, making sure that we're okay with the foreclosure, because a lender will continue with foreclosure proceedings even though the loan is an active short sale. One thing will keep going along while the other one is. And many people have a misconception that just because they put in a short sale package that the foreclosure process is going to stop, and it doesn't. Another big one is HOA dues. I want to know how far behind they are in HOA dues. If they're current, great, fantastic. I'd want them to stay current. If they're not, I want to know how far behind they are. Obviously, I can't pick up the phone and just call the HOA because they're going to want money. They're going to want money to release an estoppel, and some of them are very, very expensive. So what I do is I ask them for like the last collection letter, for example, they received from the association, or the last correspondence, and I just try to piece together what I think is going to be the balance on the HOA to put that on the closing statement so we can get the most accurate payoff amount for the HOA on the HUD, so the bank, again, understands what their minimum net is going to be. Another thing is I check to see if HOAs have sued to collect their balance or for foreclosure. Many HOAs, they don't sue in foreclosure. Instead, what they sue is on the balance. So I like to see if that's it, because if they have sued, for example, then or if the debt is with an attorney, then I know that there's going to be additional fees and expenses that I know the lender won't pay. And if I'm working, I was working the short sale, when I go to negotiate with the HOA attorney on an estoppel, I have to deal directly with the attorney. I can't deal with the HOA itself. And a lot of these attorneys they have the kind of arrangement that they have with an HOA is that they get like paid, for example, a percentage of what they collect. So many of them are very unwilling to bring down the fee too much. So that's one thing I want to have in mind. Back taxes to the IRS, I already kind of discussed that. We want to know up front, and I through the public records I can find out as well if there is an IRS lien, and if there is, I get the seller moving on that very quickly. And well, municipal code violations, really we wouldn't know until title is ordered, but that's really important. If the the lawn is really high, or those are things to consider, because some of these municipal code violations are very, very expensive, and they run every day. The clock ticks as more money that it's going to cost to get them released. Next part is really about the buyer. Obviously this webinar focuses on the seller and on processing for the seller, because in fact that's really where I have the control. I don't, if I'm for example giving you some advice on a buyer, you could always call me and ask me what I think, but in a situation where I'm dealing with the buyer, I don't, the seller obviously is not going to give me access to speak to their lender. So where I have the control really is with the seller. But for those of you, you can communicate with the buyer's agent, or for those of you who represent both sides, please tell them to be patient. Short sale is a process. It's a debt settlement, and it takes a little bit of time. So make sure that they're aware of the market. They're aware that the process requires some time, and they need to be patient. That's really the most important thing, because buyers putting a tremendous amount of pressure on a transaction really doesn't help. They have to understand that it's going to be a process, and we're doing as much as we can. And every week when we send out our weekly updates, we can include the buyer and the buyer's agent if they want to be included in the weekly email updates. That's why they see that their transaction is moving along. And very, very importantly as well, making sure that they have the money. Lenders, if it's a cash deal, they require the buyer's proof of funds. But we want to make sure that, as I've seen so much lately about buyers waiting until the short sale approval comes in order to start looking for their financing. We can't have that. It delays things too much. When the seller gives us an approval letter, they'll give us a deadline to close, and sometimes those deadlines are really tight, and I can't have a buyer at that point looking for financing. It'll just be a disaster. Many times, yeah, we can get the closing deadline extended, but sometimes the lenders will require a per diem. I see that on a transaction now that we have going. The buyer has dragged his feet and hasn't applied for financing, and also hasn't applied to the homeowners association, very importantly, hasn't applied to the HOA to see if they'll accept him. And the HOA has told him it's going to take them 6 weeks to run a background check and credit check and the whole 9 yards. And the lender is charging a expensive per diem. So those are things we try to avoid. You know, the buyers, please, you know, start, if they're interested in the property and they know we're moving it along, you know, start the process with the HOA, start the process with the financing. You know, that would make everybody's day a lot easier. Now, this is where I rely on you in terms of knowing the property. Lenders want to know that they're receiving fair market value for a property. So this is where I rely on you to have done your market analysis and determined what the value of the property, you know, should be, what the property should sell for. You know, based on comparables. Basically, you guys know that much better than I do. And this, I also rely on you guys a lot. For example, when I get a BPO that is unrealistic, when I challenge BPO, I rely on the agent to help me with the tools that I'm going to need in order to try to bring the lender back to reality. And that's really important. That's where I really rely on you, and to know exactly what to list the property for, because you know, lenders get very annoyed when we give them an offer that is less than fair market value. Now going into the, this is where I was going to show you about the foreclosure dockets. In Miami-Dade County, the one at the top, this is a www.miami-dadeclerk.com. That gives us the clerk's website for Miami-Dade County, and obviously the second one is for Broward, and the third is for Palm Beach, and every county in Florida has its own docketing system. But in the docketing system, we monitor the foreclosure process, and we also check for any, you know, liens against title. Here you'll see like a screenshot of what the Miami-Dade County Clerk's website looks like. For example, where I check the judgment and tax liens is, yeah, if you go to the left side of the screen under public records, it's going to be kind of small. Yeah, I'm going to actually have Louis bring up the website itself, because that'll give you a good idea of exactly how I look at it on the, okay, if you scroll down, Louis, where it says public records, down, okay, or official record search, I'm looking for judgment liens and tax liens. If I go to official record search, then I go to standard record search, and then there's always a name there that we use. This person has a lot of judgment and tax liens against them. Actually, when you type in the name, you can narrow it by, if it's a very common name, you can narrow it by date. And then here on where it says document type, Louis is scrolling down to any lien or judgment, and that's going to focus and narrow it to any lien or judgment, so you don't end up with a lot of junk you don't need to see. But here, for example, you can see, like where Louis is pointing at there, see the Louis pointing over here where it says LIE. LIE means a lien, and JUD means a judgment. If you're considering taking the short sale listing, this would be a mess, because, and also FTL, the one underneath it, Louis, is federal tax lien. So if you were to call me and tell me, Lydia, I have Valentin Garcia who's considering giving me his house, and to list it. When I look this up, I'm going to tell you this guy has got a ton of tax liens, judgment liens, and this is going to be a mess. So that way you would know, because otherwise you would sign him up, take his property, list it, do all of your hard work, and when the short sale approval comes back months and months later, and title runs their search and examination, they would reveal this is a huge mess and probably would never be able to close. So those are things that are so important that we like to know up front. The other thing is we want to know the status of the foreclosure case. So, in going back, Louis, to the website for the clerk of courts, we go and do under public records, civil/probate, we would do a search and then click on standard case search, and again you can search by name and pull up a docket, a case docket, and then by name you would see, for example, we can pull up one of them where SunTrust Mortgage has sued him in a foreclosure. That house, for example, if you were looking at that property, you would see that it had a notice of sale, and because in Dade County it's set, the docket is reverse chronological, so the last thing that happened is on top. There's a sale date, the sale date was reset, you can see basically the history. Sale date has been canceled up here. We keep going up, you can see he filed bankruptcy as well, somewhere in between, and then you can finally see that there was a notice of sale on 3/30/2011, and that, the certificate, it looks like the certificate of sale was incomplete. So you got to get a history of what was going on. And this property actually was, in fact, sold in a short sale. But, and looking at the docket, it can be pretty daunting and difficult to maneuver. But that property, in fact, was sold in a short sale. He was able to avoid the foreclosure sale. But that's one thing I would help you. I would look at the docket and find out what's going on. And if I see, like for example, the screenshot here, if you were considering taking a listing and it was to say November 1st of 2010, if I came and I looked at the docket, I would tell you, well, it has a sale date of November 22nd, 2010. That's not going to be something that's feasible, because even if you try to get a judge to reschedule a foreclosure sale, they want to see a short sale approval. So if the property has just been listed, we're not going to have that. So chances are the judge and the bank are going to oppose moving a foreclosure sale. I get to effects of a short sale. Here's a little bit of a recap. Obviously, HOFA will give you the forgiveness for the deficiency. The MDRA will forgive the tax liability. These are both on homestead properties. And if it's a non-homestead property and HOFA and the MDRA do not apply, if the seller has filed bankruptcy or is going to file bankruptcy, they don't have to worry about any tax liability or deficiency. And IRS guidelines for insolvency are very, very lenient, such that the chances of somebody being taxed on the capital, on the forgiveness of deficiency are very, very rare. And when you go into hardship, this is what I always tell sellers. Explain to me what happened, what situation you were in when you took out the loan and what situation you're in now. Why are you having a hardship? Because I have some sellers tell me, oh, well, now, my wife and I had a baby and we don't like the school district. Well, that's not a hardship. So I get them to refocus on what could be a hardship. Lenders look for medical crises, job losses, loss of a business, divorce, separation, and there's also 4 sample hardship letters on our website that I always direct our sellers to. Any dependents in the family have suffered health issues or increased expenses because of any particular reason. Basically, the hardship letter should tell a story in the seller's own words as to why they can no longer continue to make the payments. I also asked them, very, very importantly, have they made any major purchases recently? Because those sellers that have stopped paying their mortgage and then purchased another property, that's going to be an issue with the short sale lender. And also people who have purchased big ticket items. I had an individual who, because the lender, I will remind you, does pull credit. Bank of America especially, they pull a credit report for every short sale request. And I had a negotiator call me once and tell me that, and very, very unhappy, he was very unhappy, that a credit report revealed that my client had purchased a Porsche. So yeah, I had to hang up the phone, call the client, and be like, what is this? You purchased a Porsche? Yes, we did. I mean, to make a long story short, I was able to negotiate it, and everything was fine, but it was very, very difficult because, it was clear to the lender that the seller had taken the money that they should have been using to pay the mortgage, or part of it, and used it to purchase a very, very expensive car. So that was difficult to, for them to swallow. And in some cases, the lenders will outright deny a short sale where something like that has been done. This particular property had a lot of issues, and so I think the reason I was able to get it closed was because the lender did not want that property back as an REO. The marketability would have been horrible. I think that's what carried the day, but had those issues not been there, I don't think that that would have been possible because of purchasing a luxury item like that. So the lender will pull credit. And they'll also see, another question I ask a lot of times of the sellers is, are they behind on other debts? Because Bank of America, for example, if the seller is current on all their other obligations and is only defaulted on the mortgage, they'll use that as one of their prongs to determine whether this is what they call a selected default, whether the person is defaulting because they want to, So it's I do ask, hey, are you paying your credit cards? Have you stopped paying other things? If they have, that reflects a lot better for them in the short sale. Obviously, we never, ever, ever tell people to stop paying their bills, but when they're not paying other bills, it does make the short sale process a bit easier. And the goal, obviously, with the short sale letter is and the short sale package is to prove that the debtor is, in fact, insolvent and they can't make their payments. Their expenses, of course, are greater than their income, and they have more liabilities than assets. Well, there are many benefits of a short sale, and I think one of the biggest ones is avoiding a foreclosure. Many people don't understand the type of damage that they're doing to their life if they just let a property go in foreclosure. A lot of lenders out there won't give them another mortgage loan for 7, 8 years, some lenders at all, because if they lose a property in foreclosure, it's going to have to reflect on their 1003 application. So, they don't understand that. And many people will say, oh, I'm going to file for bankruptcy and I'm going to discharge the debt and then, then I'll be able to buy another house. Well, sure, they can file bankruptcy and discharge the debt on the note, but the lender still has to foreclose on the property. And many times that process can take years. So where somebody may think, oh, no, I filed bankruptcy, like happened to me recently with a gentleman, came into the office begging for me to help him. He filed bankruptcy almost 3 years ago and thought, now he's married, thought he could buy a house, and finds out the lender hasn't even finished the foreclosure process. So that's a tremendous problem. Until that foreclosure case gets done and resolved, and then, only then, maybe after 7 or 8 years, will he be even eligible for a mortgage. So simply walking away is not the answer. And once I tell people the effect of just walking away, filing bankruptcy, and forgetting about it, it's just, they finally get it. They understand why it's important to do a short sale. Even bankruptcy clients, I tell them, you've discharged the debt, doesn't matter. Do the short sale. It's going to help you. You're going to prevent bankruptcy and foreclosure on your credit report. Avoid the foreclosure at all costs. If you have to do the bankruptcy later because you have other debts that you couldn't, deal with, or maybe you were forced to sign a promissory note by a PMI company, or maybe your second mortgage holder required you to sign a promissory note, you can just turn around and discharge all that in bankruptcy. But at least you'll have avoided a foreclosure. 2 years after a discharge, you'll be eligible for another mortgage loan. 2 to 3 years. So that makes a huge, huge difference, and that's something that you guys can really sell out there. People don't understand what they're doing if they simply just walk away. They're seriously messing up their lives. And I've had people who have filed bankruptcy, discharged a mortgage loan, and then later been sued by the association, and they think that that's illegal. Well, it's not, because the association dues that continue to accrue are post-petition debt that's not included in the bankruptcy. So many people don't understand that. That's something you can really use out there as a tool. Don't let anybody tell you, oh, here, I'll live out, for the next 3 years for free, and, why should I list my house? They need to understand the consequences of just squatting on a piece of property. Every month that they're there, their credit gets more severely impacted. And if they walk away in the end, it's going to be very, very difficult for them to obtain another mortgage loan. And just to finalize on the caveats, just to kind of give a little bit of a recap, when you're out there assessing a short sale, the more mortgages a person has, the harder it is. Also, if the person is, just say the property is upside down, which many of them are, but the loan is current with no plans of missing a payment, that's not a hardship. It's very, very difficult to get a lender to accept a short sale if the payments are current. Of course, it creates a quandary for us because we cannot tell them to not pay their mortgage. But they need to understand, if their loan is current, the chances of the lender taking that loan and putting it into a special asset are very, very difficult. I've been able to do it before, but it's been in those more extreme circumstances. For example, I had a lady who was receiving alimony, and I was able to give a negotiator a copy of her final judgment for dissolution of marriage, which showed the day that she would stop receiving these large rehabilitative alimony payments. So there I could prove that default was imminent. I've also been successful where I've had somebody on a severance package. So it really has to be on paper. We have to show the lender that the loan is going to be defaulting imminently. If somebody has filed Chapter 7 or Chapter 13 bankruptcy, obviously we'd have to wait until the discharge in order to be able to continue with the short sale process, or request permission from the court, which is readily given, but it's just another layer of responsibility. If the loan was recently taken, obviously it's more difficult to do the short sale. Or if there's problems with title liens, judgment liens, any other type of municipal lien, IRS liens. If the loan, for example, is less than 30 or 60 days from foreclosure sale, that's a big caveat. Or if there's HOA dues are very, very far behind, that is also a big concern. So wherever the seller can remain current, that is great. That would be great. So thank you for joining us, and just get through those last slides there. And I would like to open it up for questions. Whoever would like to type in a question, I would love to be able to interact and answer them. So if you have a question, please, by all means, type it in. And when I do receive questions, I will I'll share them with everybody, just so that everyone can have the benefit of the question that was asked. And I just find that I learn so much from the agents themselves. Some of you guys have great questions. I haven't received any questions yet. I'll wait a couple more minutes to see if any of you are just typing them in, so that I can share with everyone else. And